Is China's economic strategy undermining Western markets? An in-depth examination. China has recently reallocated approximately $8 trillion in assets. Consider the scale. This exceeds the GDP of Germany, Japan, or the entire African continent combined. This maneuver is not merely a financial adjustment. It positions China to exert significant pressure on Western economies. The implications are unfolding now, following a historical pattern observed in prior shifts of global economic power, each instance resulting in substantial challenges for the incumbent. Understanding this dynamic is essential for navigating what lies ahead. In the past 2 years, China has methodically restructured $8 trillion in foreign assets, currency reserves, and trade agreements. At first glance, these appear as routine financial operations. However, they form part of a deliberate strategy aimed at reshaping global economic relations. Western observers often view this as standard practice, but evidence suggests otherwise. This aligns with a recurring framework known as the reserve currency stress cycle, a process through which emerging powers challenge established reserve currencies, leading to economic realignments. We are presently in an advanced phase of this cycle with China, a development that many investors overlook. The reserve currency stress cycle comprises 3 distinct phases: accumulation, repositioning, and activation. In the accumulation phase, economies become deeply intertwined through trade and investment, fostering mutual growth while subtly building imbalances. Reserves and leverage accrue unevenly, setting the stage for future shifts. The repositioning phase involves discrete diversification of assets and partnerships, preparing for potential decoupling without overt disruption. Finally, the activation phase sees the emerging power deploy its accumulated leverage, often resulting in economic stress for the incumbent, though outcomes can vary based on responses and external factors. Historical precedents illustrate this cycle's potential consequences. Consider the case of Britain and Germany from 1900 to 1914. Britain dominated global finance, with the pound sterling as the unchallenged reserve currency, backed by extensive colonial trade networks. Bilateral trade volumes reached 100 million annually by 1913, representing a significant portion of Germany's exports. Yet Germany pursued accumulation by amassing gold reserves, surpassing 3,000 tons by 1913, the largest in continental Europe, while forging alternative trade alliances with Russia, Austria-Hungary, and the Ottoman Empire. These moves created a parallel economic sphere, reducing reliance on British systems. Data breakdown. Germany's pre-WWI economic positioning metric, 1900 value, 1913 value change, percent, gold reserves, tons, 500, $3,000, 500 trade with allies, as percent of total, 15%, 40%, plumb 167, foreign debt exposure, high, British ties, low, diversified, 60. By 1912, internal German documents, including minutes from Berlin banking conferences and imperial treasury strategies, revealed discussions of financial tactics to disrupt sterling liquidity. This repositioning culminated in activation during World War I's onset. Germany froze British assets and recalled gold from London, precipitating a liquidity crisis that nearly collapsed the Bank of England. Britain suspended gold convertibility and sought U.S. loans, marking the beginning of sterling's decline. Within 3 decades, the dollar supplanted it as the global reserve. While military conflict accelerated the process, the underlying economic leverage was decisive, demonstrating how the cycle can erode dominance. A more recent example is Europe and Russia from 2000 to 2022. Post-Cold War, Europe cultivated energy interdependence, with Russia supplying 40% of the EU's natural gas by 2015, peaking at 65% for Germany, 50% for Italy, and 40% for Poland. This accumulation phase generated mutual prosperity, with annual trade exceeding $250 billion. Russia, however, built reserves exceeding $600 billion by 2020, tripling gold holdings to over 2,300 tons and reducing dollar exposure from 50% to under 20%. Data breakdown, Russia's reserve buildup and diversification metric, 2,000 value 2020 value change, percent. Foreign reserves, B, $25,600, 2,300 gold. Holdings, tons, 400, top 2, $300, $475 share in reserves. 50%, 16%, 68 alternative payment systems, e.g., SPFS transactions. Negligible 100B annually, Yearn A. In repositioning, Russia developed the SPFS system as a swift alternative and strengthened ties with Asia, the Middle East, and Africa, rerouting 30% of exports by 2022. The activation phase materialized amid the 2022 Ukraine conflict. Western sanctions froze reserves and severed SWIFT access, yet Russia's preparations mitigated collapse. The ruble recovered within months, strengthening beyond pre-war levels. By weaponizing energy flows, reducing gas supplies by 60%, Russia induced European inflation spikes to 10 to 20% and a 30% drop in industrial output, with energy prices surging 400%. This inflicted lasting damage on Europe's economy, highlighting the cycle's risks, though Russia's own growth slowed to 1 to 2% annually amid isolation. Applying this to China, the cycle began with accumulation from 1990 to 2010, as U.S.-China trade surged from $10 billion to over $500 billion annually. China amassed $3 trillion in reserves by 2020, becoming the largest holder of U.S. treasuries. Initiatives like the Belt and Road, involving $1 trillion across 150 countries, and the Asian Infrastructure Investment Bank provided alternatives to Western institutions. A central bank digital currency processing over $250 billion in 2023 further enables sanction circumvention. We are now in repositioning. China's U.S. Treasury holdings fell from $1.1 trillion to under $800 billion. Gold reserves rose 70% officially. Estimates suggest 5,000 plus tons, and yuan-based swaps cover 30 plus countries. CIPS volumes grew from 100 trillion yuan in 2022 to 150 trillion in 2023. In November 2023, state enterprises were directed to divest $8 trillion from Western assets by 2026. Data breakdown: China's recent asset repositioning asset category 2021 value 2023 value change Yinbao percent U.S. Treasuries B $1,000 $800 $20 gold reserves tons official 1,950 monthly $300 plus 70 CIPS transactions trillion to yuan mais 80 150 188 Belt and Road investments T05 1.0s $100. Activation could involve coordinated treasury sales, potentially spiking U.S. interest rates and forcing inflation or recession. Selective supply chain restrictions, given China's 60-90% control of semiconductors, pharmaceuticals, and rare earths, and promoting yuan-based systems, with 40-plus countries testing digital yuan. However, this is not inevitable. Probabilities depend on geopolitical tensions, U.S. policy responses, and global economic conditions. A 2023 IMF report estimates a 20 to 30% risk of rapid dollar devaluation if reserves shift abruptly, though diversification could mitigate broader fallout. Common misconceptions amplify risks. First, assuming mutual dependence precludes conflict ignores history. Germany and Russia proceeded despite ties. Second, the dollar's dominance, 60% of global reserves, is eroding amid U.S. debt at 124% of GDP, $34 trillion adding $2 trillion yearly. Interest over $1 trillion. Third, response capabilities are limited. Rebuilding supply chains could take 5 to 10 years. Preparation involves assessing probabilities. Divestment timelines suggest elevated risks by 2026, with a 40-60% chance of market volatility per derivatives pricing. Reduce exposure to dollar-dependent assets, favor defense, domestic manufacturing, energy, agriculture, gold, and Bitcoin. Stock essentials for 3 to 6 months against disruptions. This cycle is probabilistic, not predetermined. Central banks are diversifying, gold purchases up 30% in 2023, and informed positioning can preserve wealth. History underscores the stakes. British pound holders and European industries faced severe losses. The $8 trillion shift signals potential realignment, possibly transferring influence to China. Monitor developments closely. For detailed sector impacts and timelines, like and subscribe. The next video will analyze probabilities and strategies.